I'm Greg Wellborn with First Financial Consulting here in Pasadena, California. Welcome to our webinar on Investments 101, the good, the bad, and the ugly. Now, before we get started, I just want to walk you through a little bit about how to use this webinar for those of you that have never done one or aren't familiar with this particular software program. First off, we've muted everybody. We don't need 100 voices chattering in at once, so don't be offended. Number two, we are going to take questions. There is a bar on the side of the screen where you can type your questions. And we promise we're not going to call you out, unlike that high school teacher we all had. So we really want to encourage you, give us your questions, because we really want to address issues that are of concern to you in this. I also want to just take a moment and give a special thanks to my assistant, Cordy, here, who's serving as producer today. And I assure you that if everything goes 100% well in this particular webinar, I'm going to take credit for it. But if there's a hiccup, I am throwing him under the bus. Now, our goal today, just so you understand what we want to do, is first of all, we want to give you some value, some information that you can use. We want to have some fun doing it, make sure that you got some takeaways, actionable items, and hopefully we're going to have a little fun in the process. We'll tell some stories, relate some truths. We've all made mistakes. We can learn from those. So hopefully there's going to be a give and take here and everyone's going to enjoy this. We also especially want to let you know that we're going to honor our time commitment to you. So if we can get through and get to questions, great. If not, we will address them afterwards in emails. So let's first start with what is an investment? That's what we're talking about, is investments and investment 101. Well, what is an investment? It means that you're taking your money and you're putting it somewhere that's actually going to earn something for you. It has to generate a profit on what you're invested. That's not the same thing as savings. Savings is just the act of putting the money aside. So where you put that savings determines whether or not you're actually investing. And putting it under the mattress or in cans in the backyard is not investing. And it sounds funny, but that's a legitimate story. It's a truth. I had a client come in, husband and wife, and they're describing to me what they've done, what they want to save for. It happens to be a swimming pool, and the husband comes off with, yeah, we're investing. I'm putting the money in cans, and I'm burying them in the backyard. And I'm looking over at the wife like, it's a joke? Do I laugh? No. She affirms this is legit. That's what he's doing. Well, how much do you have invested? I ask. He's not really sure. Politely as I can, I try to let him know this really isn't investing. And his response is, yes, it is. When they start to dig for the pool, they'll find the cans, they'll find the investments, and we'll be able to pay for the pool. So we joke about that, but as you can tell, this is not the mattress, the backyard, even the savings account. That's just treading water. That's not really investing. Now, there are three general categories of investments. There's stocks, bonds, and real estate. Now, there are hybrids, but we're going to stick with the basics for now. We're also going to leave real estate for another discussion. It's got complexities in its own right. So today, we're just going to focus on stocks and bonds. Reality is that's the lion's share of what you're going to read about, what's available to you in your account. So we're going to cover the waterfront there. But how much you invest in stocks and in bonds is going to determine essentially two things. One, a large part of the return that you can earn, and secondly, the amount of risk, the amount of volatility and the downside that you're accepting along the way. So let's take a moment and talk about each of these. What is a stock? What is a bond? Now, to do this, I'm going to refer to one example through most of this webinar. I like to use Apple for a couple of reasons. One, everyone knows it. Two, it illustrates all the concepts. And three, most important, it makes me actually look hip, like I know technology. I don't. Just ask Cordy or any of my kids. If I were in charge of technology of this webinar, we'd probably be shutting a toll road down somewhere. But in any event, we're going to use Apple. Apple's a company, we probably all know about the products, that the services they do. What we maybe not realize is how do they finance what they're doing. And they got a couple of choices. One is they go to the bank and they borrow. You're not the bank, so we're going to take that out of the mix. The second is they come to you, and they'll come to you in one of two ways. So let's talk about the first one, stocks. Here's what they might do. They come to you and they say, we got a killer deal. You can buy stock. You can be an owner in Apple. Just give them $1,000 and you own a share of Apple or whatever the price is right now. But that really is what a stock is. It's a piece of paper, usually got nice colored print on it and some pictures and whatever, but it says you, the owner of that share, own a share. 1/1000th, 1/millionth, however many shares there are of that, you own that fractional share of Apple. Well, what do you own? You own the buildings, believe it or not. You own the factories, you own the equipment, you own the pencils, you even own the office supplies. You have your fractional share of everything that is Apple. Now that really won't do you much good. You can't just stroll into one of those factories or even into the local Apple store and say, hey, I need that ream of paper because I'm going to go buy a gallon of milk. They're not going to let you do that. More importantly, you own a fractional share of Apple's profits. You see, all those assets that they own, you own, are being used to produce something, produce a product which is sold hopefully at a profit, and therefore you own part of those profits. As those profits go up, the price of your stock goes up. Now if they go down, the price of your stock will go down. On the screen right now, we've got a chart which shows the history of Apple stock over a recent time period. We've also dropped in some boxes to kind of call out major occurrences, both good and bad, great product launches, bad product launches, the finding of a great CEO, the firing what they thought was a great CEO. But you kind of notice that all these events, these occurrences, these product launches, whatevers, have seemed to follow with a trend of up and down. Good ones mean, well, the price is going up. Bad ones kind of correlating with those drops. And the reason for that is not because people either liked a particular iPhone or disliked a particular iPhone, liked that CEO or disliked that CEO. What they were doing, investors, is figuring out, well, what do those events mean for future profits of the company? And you see this very volatile up and down ride, but over the long term, you kind of see this going up. As an owner of stock like Apple, it would be realistic to see this sort of volatility for an average annual return of somewhere in the neighborhood of 10%. You've just got to put up with that volatility in order to get that type of long-term rate of return. But let's say you don't want to. Let's say you say, okay, I've looked at that. Those are some pretty big drops. I don't want, thank you very much. You push back from the table and you're ready to walk away. That's where bonds comes in. Apple says, wait a minute. Before you leave, we've got another deal for you to consider. Instead of buying a share and being an owner of Apple, why don't you lend us the money? Lend us $1,000. We'll pay you back in 1, 3, 5, 10, 20. There are a lot of options here, years. And we'll pay you 4% along the way. That's what a bond is. You've lent money. It's a piece of paper. Again, it's an IOU. We, Apple, owe you $1,000 in my example, and we'll pay it back to you in whatever number of years has been specified, 1, 3, 5, 10, etc. And along the way, we'll give you 4%. Again, I'm just using that as an example, 4%. Now, the advantage to this is that no matter what Apple's profits do, within reason, we're not talking about bankruptcy, but whatever they do up and down, there aren't going to be as many wild swings in the value of the bond because the value of the bond is kind of set. It's $1,000, give or take a little bit of fluctuation. You're going to get your money back. So there is some amount of volatility to bonds, and the slide that you've got on the screen right now shows that. I want you to forget the top line for a moment. We're going to use this slide again. But I want you to look at the bottom line. That represents about what the bond's volatility would be relative to, say, a stock's. So here's the difference. You've got the stocks with the higher potential return, the higher volatility, the bond with the lower potential return, the lower volatility. So what do we do with that? Well, let's say you and a friend happen to be in the room, you're taking that pitch from Apple. You both hear the pitch, but you each make two different decisions. Your friend says, hey, let me take the stock deal. You go ahead, you take the bond deal. Okay, you do it. Well, let's also say that Apple is wildly successful conquering the Norwegian market with the iPhone 58. Remember, stock prices are going to go up as profits go up. Now, Norwegians are locked down for all winter, maybe even parts of the spring and the fall. I have no idea how bad it gets there, but they got nothing else to do but talk on their phones. So they're gobbling up the i58. Profits are going up. Price of the stock is going up. Your friend gets that 10%. You get 4% because you took the bond. You're probably wondering, well, just how good a friend is that? Feel a little stabbed in the back, aren't you? Yeah, thanks for nothing. Take the bond deal, he says. Well, that opinion is formed in hindsight because it could have gone the other direction. Apple's stock could have gone down. Let's say the i58 was a disaster, as was the i59 and the i60. And at that point, people are buying Google phones and Tesla phones. You know, they'll probably have them by now. Well, now your friend has lost 20% in the price of his stock, and you've earned your 4%. So now who's feeling kind of backstabbed? Who got the worst deal? The point is that you made this decision. You had the option of striving for the higher potential return and accepting the higher volatility, or looking at taking the lower volatility and thus settling for a lower rate of return. Stock values are driven by profits. Bond values are driven by the value of the bond, give or take some fluctuation for interest rates. Stocks tend to be higher, bonds tend to be lower, both in terms of return and volatility. So you get that now. What I need to do at this point is to shift gears a bit. We've been talking about one company, Apple. That's dangerous. I don't want you to deal with one company, one stock, one bond. I want you to think a little more broadly. See, in any one company, it could go bankrupt, even an Apple. Think back to, well, Sears is probably the most common name that we know of that fell on really hard times, having been a leader in its industry, a member of the S&P 500, one of the biggest, most successful companies in America, and it went kaput, essentially. So one company can go bankrupt, which means the stock goes down, is worthless, and even the bond can be worthless. So we're not doing that. We're thinking now in terms of stocks broadly, say the S&P 500. That's the Standard & Poor's 500, the 500 largest companies publicly trading in America. And let's also look at bonds broadly speaking. We're bringing that graph back up, that chart, and now I do want you to pay attention to both the top line and the bottom line. The bottom line is essentially the aggregate Barclays index of all bonds in the US. And that top line is the S&P 500. So this is now what that chart is illustrating, that trade-off between higher volatility and higher return with lower volatility, lower return for the bonds. Now, at this point, you might be thinking, this is easy to do. I've attended this webinar. I trust this guy Greg implicitly. Thank you very much. I want that 10% average rate of return. I don't want that 4, and I am not going to use just one stock. I'm going to go use broad stocks or broad bonds so as to diversify. Well, not so fast. You see, so far, we've been looking at the roller coaster from the sidelines, and looking is always easy. Doing is much more difficult. So yeah, it's a cartoon, it's a funny chart, but it kind of illustrates what it's going to feel like being on that roller coaster. You can't just decide on what rate of return you want. That is important, but you have to also decide that you're going to be willing to stay invested in that strategy during the bad times. The bad times are the price for the good times. Now, you might still think this is easy. But you have to understand human nature, your own nature, my nature as well, all of us. We're part rational and part emotional. Decisions are made from both areas simultaneously to greater or lesser degrees. And let me illustrate what actually can happen, has happened, may be happening with you. The slide you're looking at right now shows the broad stock market's performance over a couple of major ups and downs. And I'm going to quote to you now from the same major network newscaster, from the same major network news channel. Now, at one of those highs, he said, and again, I'm quoting, "It's a new paradigm. The old rules of investing don't apply. The sky's the limit." Well, what does the average investor do? They get into stocks in a big way. Everybody wants a part of that ride up. Now, at one of those lows, and again, I'm quoting at newscaster, it was 9 months away from the high, he said, "This is the worst recession since the Great Depression. There's no bottom in sight." What does the average investor do? They bail on those stocks. Who wants to keep riding this puppy all the way down? Does this sound like you? Sound like someone you know? Now, be honest, we're among friends. The reason I ask that is because it does happen, and it has probably happened, if not to you, among friends. Okay? This is what average investors do. They buy on greed, they sell on fear, they repeat the process. Notice how over the long term, though, this chart, even with all its ups and downs, all that volatility, it goes up. Stocks generate tremendous value over the long term. But the average investor takes a long-term positive rate of return and usually, many times, converts it into a personal negative rate of return. How do I know this? Morningstar is a company that brings in and looks at a lot of data on stocks in the United States. And they did a survey, a little study over a 10-year period of time. And in that period, they found that all these stocks combined generated an average annual rate of return over 10 years of 10%. Just happened to work out 10 over 10. That's not the point of it. The point of it is that they also, because they were looking at the inflows and the outflows, Morningstar is tracking not your name per se, but it's tracking all the money that goes into stock funds, all the money that comes out of stock funds, etc. They could see the ins and the outs. They could see the timing of the ins and the outs. They were able to calculate what the average investor's return was in those stocks during that 10-year period of time. And the average investor did not earn a positive 10%. The average investor earned a negative, a minus 2%. Yeah, that's right. They lost 2% per year on average during a time period when if they just stayed put, they'd have earned an average of 10% to the positive. Now, the allocation is the key. You've probably heard that term before, fancy term for how are you going to mix stocks and bonds. You see, most investors should not be at either extreme, not 100% stocks, not 100% bonds. But where in the middle, and what is the middle? Well, the middle is essentially different combinations of stocks and bonds, broadly, categorized, but 80-20, 70-30, 50-50, whatever that combination is, the middle is some portion of bonds, some portion of stocks. It's an allocation, fancy word for saying how you mix that together. Now, how you mix those together is going to determine that rate of return and that amount of volatility. The returns, these differences, we've been talking about 4 to 10% in our example, they're extremely important. I almost can't emphasize how important they are. But we've tried to put together a chart that I'm going to walk through with you, will help you here. What we're showing is 3 rates of return: 4, 7%, 10%. Now notice that there's a 3% difference between each of these, from 4 to 7, 7 to 10, 3% each way. Now what we've also shown is, well, what would $1,000 grow to over 24 years at 4%, 7%, 10%. Now we're using 4% as our base, and notice that 4% over those 24 years would take $1,000 and would grow it to $2,563 some odd dollars. 7% would take that same $1,000 and would grow it over 24 years to $5,072. That's roughly a doubling of what you could earn at 4%. So by targeting 7%, and one assumes achieving that over 24 years as an average annual rate of return, you'd have double the amount of money targeting 7 than you would targeting 4. Now notice what happens if you had said, I'm going to target 10, and you were able to withstand the volatility of the 10 and achieve an average annual rate of return of 10% over 24 years. That $1,000 would have grown to $9,849 some odd dollars. Interestingly enough, that's roughly double what you would have earned if you had targeted 7%. Now, you're probably catching on here. A 3% difference over 24 years represents a doubling of your money. So from 4% to 7%, just a 3% difference doubles your amount of money. From 7% to 10%, just a 3% difference, represents a doubling of your money. So what does that mean is the difference between 4 and 10? A doubling and a doubling again. So that 6% difference, its target rate of return for 24 years, from 4 to 10%, represents a quadrupling of what that growth would be. As you can see, this is extremely important. Now, just a reminder that the volatility goes up with those returns, but the return differences, as you can see, are extremely important. Now, the good news here is we can analyze these different allocations, between this 4 and this 10 in my example, and between the 80-20, the 70-30, the 60-40, whatever these splits are, these allocations between bonds and stocks. We can be pretty accurate in measuring and telling you what they would be, both on the return side as well as on the volatility side. Now, that sort of predictability, I will speak about that a little bit later, but that sort of predictability is extremely important as well. Please do not accept words like conservative or moderate or aggressive. I don't care if you're talking with an advisor, a stockbroker, your friend on the golf course. Don't try to define what you're going to do by terms like conservative, moderate, aggressive, because they mean different things to different people. Interestingly enough, the studies show they mean different things to the same person at different stages of life. So you and I could be having a conversation, and you're talking about a moderate portfolio, and I'm talking about a moderate portfolio, and I mean something entirely different than what you mean. And so we're not communicating, we're missing one another. What we want to do is talk in terms of real rates of return that can be earned and real amounts of volatility that must be experienced for that. Remember, that's the price. Those downside blips are the price for the good times, for that average annual rate of return that's going up. Now, at this point, we've oversimplified because we've just used one category, stocks, one category, bond. The reality is it's a little more complex, a little more difficult to achieve this. It's still possible, but there are multiple categories of stocks. There are multiple categories of bonds. You've got large stocks, you have smaller stocks, there's international stocks. Now, there are shorter term bonds, there are longer term bonds. You get the idea. The concepts are exactly the same. For each of these, we can be very predictive in terms of what the return's going to be and what the volatility will be. We can mix all of these different categories of stocks, all of these different categories of bonds together and come up and give you a predictable number in terms of what your rate of return would be and in terms of what the volatility that goes along with that is going to be, so you can make an intelligent decision. So we boil it down. Successful investing requires a couple of things. One, know your time frame. We haven't talked a lot about that up to now, so let's just take a moment. This works for the long term. There's been a reason that I've talked about 10 years and 24 years, because over the long term, we can be amazingly accurate in our predictions. But over the short term, there are no guarantees. You ask me, well, what's the stock market going to do tomorrow? I have no clue. What's the stock market going to do the balance of this year or even one full year from today? I have no clue. You start getting into 10, 15, 24 years, I can be very, very accurate. So know your time frame. Number two, know yourself well financially. What average return do you need? You know, this shouldn't be done in some sort of vacuum where you're saying, well, gee, do I want 4? Do I want 10? Do I want 7? Okay, well, I get the volatility. I'm comfortable with that. I'll pick that, because what does that mean to your financial future? What are your goals? What do you need to achieve in order to get from point A to point B? What cash flow do you need? That's a component of knowing yourself well financially. If along the way, whatever your time frame is, whether it's 10 years or 15 or 20 years, are there points where you're going to need to withdraw some amount of money? Because if so, we need to make sure that a part of that allocation is in a component that would allow you to withdraw if the market was down and not suffer real losses. In other words, a kind of a safety valve where you can withdraw from along the way. Number three, know yourself emotionally. Okay? What is that volatility level that's really going to cause you to panic? I usually joke about chewing Malanta at 2 a.m. in the morning, getting ready to call me to say, what have you put me into? What's going on? Or calling any advisor that you're working with. The point is, you need to identify where you are, who you are, what you can tolerate, what's going to cause you to sleep or not sleep at night, and you don't want to be there. You want to be shy of that. Number four, you got to blend all of this together then into what you want to do for your portfolio or your portfolios, plural. What? Why plural? Because you may have different goals. Remember how I said goal is important? What are you trying to achieve? Well, let's say you've got a couple different goals. You want to get a bigger house. Going to happen in, let's say, 6 years, and you got to put the kids through college. Maybe that's going to happen in 10 years, and you want to retire, that's going to happen in 20. Different goals, different time frames. It's entirely possible, reasonable in fact, that you'll have different portfolios, different goals, different structures. Okay? Number five, stay committed for the long term. Whatever that might be, whether it's one long-term strategy or several long-term strategies for several goals, several funds, several portfolios. Once you make all these decisions and you know where you want to be, you've got to stay with it. You can't bail. Now, how do we implement this? Once you've decided on the right structure for your portfolio or portfolios, you have to implement, right? You have to find a way to get into stocks or get into bonds. And we used the example of one stock, one bond, one company, and I said it was dangerous, and it is dangerous because any one company, I'm repeating, but it's worth repeating, any one company can go bankrupt. Therefore, any one stock can become worthless and any one bond can end up becoming worthless. So what you need to do is we want you to we want you to be diversified into many stocks and many bonds in whatever that proportion or percentage is. 100%, 80%, 60%, whatever that stock bond split is. Don't use one stock. Don't use one bond. Don't even rely on 5, 10, or 20 stocks and bonds. The odds of life are still high. See, the reality is that even 10 or 20 stocks or 10, 20 bonds is a very, very concentrated portfolio. And any one of them going bust would mean that's a big impact on the overall. So instead, what we want you to use are mutual funds or their cousin institutional pooled funds. Now, I get it, mutual funds have had a bad rap. But you know what? So have doctors and lawyers. We still need them. We still use them, right? Oh my gosh, did I just say that? We need lawyers? Oh, don't get upset. Just kidding. Some of my best legal jokes come from lawyers. So no harm, no foul, right? Don't sue me, please. The point is, a mutual fund can be good or can be bad. And a mutual fund really is simply, it's a fund. It's a pool of money into which you've made a contribution. So has somebody else. Look, let's say I had $500 to invest. I actually would be fairly limited in the number of stocks that I can buy, probably some in the neighborhood of like 10. And I said that's a pretty concentrated amount. So I'm struggling if I've only got $500 and I'm trying to actually buy stocks individually. But what if I put my 500 into one of these pools, one of these funds, and let's say one of you does, and another one of you does, and someone else does, and pretty soon with a whole bunch of $500 contributions, we've got a pretty large pool of money. So large, in fact, we can hire a manager to kind of oversee it and make the decision on which stocks and which to buy. And let's say they can buy 50, 75, 100 stocks. We will all own a share of those 100, 75, or 50 stocks. Whatever that manager we've hired in our mutual fund goes out and buys, we all own our representative share of that. And what we've done is we've diversified away what's called individual security risk. That's the risk of any individual security going bust and really hurting the portfolio. And if you only got 5, to go to the extreme of my example, and one of them goes bust, that's what, 20% of your portfolio has gone bust. If you're in a fund that's got 100 and one of them goes bust, that's only 1% of the portfolio. So we can diversify away individual security risk. If properly done, that's obviously an important caveat. The risk of losing your money is as close to zero as it's going to get without being zero. I can't say there's zero probability, but I can say you can get really, 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 really close because it's the truth. You still have to make the basic decision, that trade-off between high return, high risk, low return, low risk, and therefore between stocks and bonds. But the risk of bankruptcy or default can be reduced almost entirely to the point where it's eliminated. Now back to that example of good lawyer, bad lawyer, good doctor, bad doctor. There are some mutual funds out there, probably why they got the bad rap. They're high fees, exorbitant commissions, lousy performance. Yeah, they're bad. But there are also funds out there that are inexpensive, they're well managed, high quality, great performance, they're good. So there are good funds, there are bad funds. And the critical point here is that good funds will diversify away the individual security risk. And suffice it to say, there is an objective way to rationally pick those funds for your portfolio. Doesn't have to be from what a salesman's selling, doesn't have to be from a stockbroker who's taking a commission, doesn't have to be from your friend on the golf course who may or may not really be telling you the true scoop about what he's done. There are objective professional ways to pick among the funds to implement your strategy. Doesn't have to be darts thrown against the dartboard. So let's wrap up some key points on how to be a successful investor. Know your time frame. Remember, this works for the long term. It doesn't work for the short term. Know yourself well financially. What's the goal? What do you need to achieve in terms of rate of return? What cash withdrawals might you need to make along the way? Know yourself emotionally. What can you withstand before you're going to bail because you don't want to bail? Blend them all together in a way that makes sense for one or several portfolios, depending on whether you have one or several goals. Use an objective process to identify quality funds in each category that you need to be in. Remember, I said there's multiple stock categories, multiple bond categories. You're going to pick funds for each of them. Use an objective process in doing that. Stay committed to the long term. No fear, no greed. And now I want to add one more. Get help. What I've described is easy. The concepts, they work really, really well. It's difficult to implement, to do yourself for a couple reasons. First of all, cutting through all the sales hype and all the extraneous data is tough. Now, we've come a long way in the last 30 years or so. It used to be there was very little data available. Getting good data was tough to do for the average investor. We're now here in the age of the internet. There's more data, more websites, more stuff thrown at you can shake a stick at. So today the challenge is to cut through all the data, all the white noise, all the sales hype, and find the data that really means something. Two, second reason. This takes time and resources to be great at investing. Now, I like to use the example of home repair. Look, I think I'm pretty good at the job that I'm doing, in my business, and I'm okay at small projects at home. Carpentry, plumbing, I can do. Hell no. I'm kind of lying on the plumbing. The last time I tried plumbing, I flooded the place. But I can do the carpentry. I can do small jobs. But if it becomes a big job, I'm going to hire a pro. Because by the time that I put in the time to learn the intricacies of doing a big job really well, make the mistakes that are inevitable, learn from them, go buy new supplies, redo it, I've wasted a lot. Where if I just hired the pro that knew how to do it, I get the benefit of all that experience. So investing is really no different if you think about it. Could you go out and learn everything that a professional advisor knows? Sure. Will you probably make mistakes? Yeah. Will those cost you some? Yeah. Is it easier to hire a professional? Right, it is. Just hire a good pro. But not just any pro. There are lots of people, unfortunately, that use that title of investment advisor, professional advisor. This is clearly one of those areas where buyer beware. You've got to watch out. Let me take a few minutes to just share with you what a true professional does. A true professional will provide you three things: objectivity, predictability, and accountability. We've talked about some of them, but let's recap real quickly. Objectivity. No axe to grind. The professional doesn't have a commission riding on the decision. They're not recommending something that's in their back pocket that their firm's got in inventory. They're able to give you objective information because they get no fee, they get no commission. They get paid by you and by you only for the advice, not for selling a product. Predictability, well, what does that mean? We talked a little bit about that, but let's, again, quickly recap. Don't talk moderate, don't talk conservative, don't talk aggressive. What do those mean? Different things. Talk in terms of real numbers. Someone should be willing, if they're professional, to sit down and say, look, we think you can earn an average annual rate of return of, and I'm going to my example back, there's 4 to 10%. We think this is the range. And here are the different points along that range. And here's what that volatility looks like, the downside looks like at each of those points in the rhythm. They're being predictable by doing that, right? Now you can look at those and go, I want to be at 6 or at 8 or at 7 because I understand what it's going to do and I understand what I have to put up with. What's the third one about? Accountability? Great term, right? It is. It's a great term, and it really means something. Professionals should be willing to hold him or herself accountable to whatever he said or she said that they can do for you. If they've said, look, this is the spread, this is what we think is going to happen, you've picked one, let's say you've picked the 7% target return, they should be willing to hold themselves accountable over a reasonable period of time to achieving that, right? Like any job. You get a job description at some point along the way, you sit down with your boss and say, did I do a good job or did I not do a good job? And you take corrective action if necessary. But if you don't bring accountability into it, there's no potential to take corrective action. You'll never know whether you're doing a good job. So the true professional, objective, predictable, and accountable, these are the hallmarks of the fiduciary standard, which is a commitment to always act in the client's best interest. We meet that standard. We are a fiduciary. We provide objective help. We do it and provide you predictability, and then we hold ourselves accountable. So if we can help, we would love to do that. If we can just have a conversation to touch base, to see where you are, what your needs are, what your concerns are, even to give you a second opinion, we'd love to do it. So please give us a call, send us an email, go back to our website, fill out one of the request a consultation form. Be happy to begin that dialogue with you. So that actually ends up burning our time today. I want to thank you very much. We have to conclude our webinar to honor our commitment to you, but we will get back to you with your questions, so you keep them coming in, and we will see you the next time. I'm Greg Wellborn, and I want to thank you for listening.